Friends, thank you for being here today. What if I told you that on December 2nd, 2025, a 175-year-old financial institution simply ceased to exist? Not because it failed spectacularly, not because of scandal or fraud, but because the system itself decided it was no longer allowed to compete. What if I told you that the bank that survived the Great Depression, two world wars, and the 2008 financial crisis couldn't survive the interest rate environment of 2024? Laurentian Bank, founded in 1846, is gone, and this is vanishing in real time. The official story is sanitized strategic review, operational efficiency, shareholder value. But here's what actually happened. National Bank is absorbing its retail customers, your deposits, your mortgages, your small business accounts. Fairstone, known historically as a high interest alternative lender, is taking the commercial loan portfolio for $1.9 billion. And the Laurentian branches, all 57 remaining Quebec locations, are closing. The employees aren't being transferred, they're being told to apply for open positions. This isn't a merger, this is a carcass being picked clean, and this part has already begun. Let me be precise about what we're witnessing. This is not a single bank failure. This is the architectural completion of a consolidation trap that has been tightening around the Canadian financial system for decades. Within the span of 1 year, 2025, National Bank has swallowed Canadian Western Bank in the west, and now Laurentian's retail operation in the east. The map is being colored in by the Big Six, and the middle class of banking is being systematically erased. The scale of this is staggering, but not in the way you might think. The shocking number isn't the $1.9 billion price tag for Laurentian's commercial arm, though that's a fraction of what this institution was once worth. The truly incomprehensible figure is zero. $0, zero value, zero choice. You woke up as a Laurentian Bank client. You went to bed as a National Bank client by force. You had no vote. You had no option. The option itself has been removed from the market. This is a structural fault line, and what I'm about to show you is why this moment represents something far more dangerous than the death of one bank. This is the death of competition itself. Now, before we go further, let me show you what actually happened, because the mechanism hiding in plain sight is something even analysts tend to miss. Laurentian Bank was the working class bank of Montreal. It was founded in 1846 to serve the people that the established banks wouldn't touch: tradesmen, small merchants, immigrants building new lives. It survived every financial catastrophe this country has ever seen, every single one. But it could not survive the interest rate shock of 2024 and 2025. Let that sink in for a moment. The current economic environment is more toxic to independent financial institutions than the Great Depression was. This is not theoretical, it's observable. The same forces that are crushing mortgage holders and small businesses have now crushed a 175-year-old bank. Here's the part they never put in the official reports. Laurentian didn't fail because of bad loans or reckless trading. It failed because the cost of existing as a mid-sized bank became unsustainable. Think of it like this. Imagine running a grocery store where you have to compete with Walmart on price, Amazon on delivery, and Whole Foods on experience. But you're doing it with 1970s technology and a tenth of their buying power. That's what Laurentian was facing. The big six banks, Royal, TD, Scotia, BMO, CIBC, National, have something Laurentian could never afford: scale. They can absorb the massive technology investments required for modern banking apps. They can spread regulatory compliance costs across millions of customers. They can offer competitive mortgage rates because they're funding them with cheap deposits from coast to coast. Laurentian had none of these advantages, but once this shifts, everything above it starts to shake. When interest rates were at zero or near zero, the game was manageable. Small banks could borrow cheaply, lend at reasonable spreads, and survive on thin margins. But when the Bank of Canada raised rates from 0.25% in early 2022 to 5% by mid 2023, and then held them there through 2024, the foundation crumbled. Suddenly, Laurentian was paying significantly more for deposits while competing for borrowers who could get better rates at the Big Six. The margin, the lifeblood of banking, vaporized. And here's where the countdown quietly began. What I call the big secret of the entire system is this: banking consolidation isn't a side effect of high rates, it's the intended outcome. Central banks and regulators have spent the last 15 years since 2008 creating a framework where only the largest institutions can survive stress. They call it systemic risk management. What it actually means is that if you're not designated a systemically important financial institution, a SIFI, you're not built to last. Laurentian was never going to be designated a SIFI. It was too small, too regional, too focused on Quebec. And in the post 2008 regulatory environment, that became a death sentence. The compliance cost alone, the reporting requirements, the capital buffers, the stress tests, these were designed for giants. Laurentian was spending millions to meet regulations written for banks 50 times its size. This is where common sense actually becomes your enemy. You might think, well, if they couldn't compete, maybe it's just natural selection. Maybe the market is working. But that logic does not apply here. This isn't a free market. This is a regulated cartel. Let me show you what actually happened in the final months. By late 2024, Laurentian's board faced a stark reality. Their net interest margin, the difference between what they paid depositors and what they earned from loans, had collapsed to near zero. Their stock price, which had once traded above $50, was languishing below $15. S&P Global had them on credit watch negative. Institutional investors were fleeing. The writing wasn't just on the wall, it was carved in stone. So they launched what they called a strategic review. This is the code word for we are failing and we need to sell before we collapse. And here is where the cascade becomes unstoppable. National Bank, which had been quietly building market share across Canada, saw an opportunity. They didn't want the whole bank, they just wanted the good parts, the retail deposits, the performing mortgages, the small business relationships, the parts that could be integrated into their existing infrastructure with minimal friction, the syndicated loan portfolio that National Bank actually wanted. Fairstone, on the other hand, is a different beast entirely. This is an alternative lender, a company that specializes in higher risk, higher rate lending to borrowers who can't access traditional bank credit. They took the commercial loan book, the riskier assets, the parts that National Bank didn't want to touch, and they paid $1.9 billion for it. Now, here's what that looks like on the ground. If you were a Laurentian customer with a simple checking account, a mortgage, maybe a small business loan, you're now a National Bank customer. Your mortgage terms haven't changed. Your account number might be the same for now, but the institution you chose to do business with no longer exists. You didn't choose National Bank. National Bank chose you. And this is where everything changes because National Bank isn't keeping those 57 Laurentian branches open. They're closing them, every single one. The official explanation is operational efficiency and digital transformation. The reality is simpler. National Bank already has branches where it needs them. The Laurentian footprint is redundant. So the branches close, the employees are laid off or forced to reapply for jobs they already had, and the communities that relied on local banking relationships are left with one less option. This is the moment small businesses get crushed. If you were a small manufacturer in Trois-Rivières who had a 20-year relationship with your Laurentian branch manager, someone who knew your business, understood your seasonal cash flow, approved your lines of credit based on trust and history, that's gone now. You're now account number 847362 in National Bank's system, and your next loan application will be processed by an algorithm in Toronto. For the average household, this means you are no longer a customer. You are a data point. You are a liability on a balance sheet that was acquired not because National Bank wanted to serve you, but because they wanted to eliminate competition. We don't have months. This is happening in days. The regulatory approvals came through faster than anyone expected. The deal was structured to avoid the kind of public scrutiny that might slow it down. By the time most Canadians heard about this, it was already done, but that's not the real problem. The real problem is what comes next, because Laurentian Bank is not an isolated case. It's a template. It's a proof of concept. It shows every mid-sized financial institution in Canada exactly what their future looks like. Acquisition, dismemberment, erasure. Canadian Western Bank gone, absorbed by National Bank earlier in 2025. Laurentian Bank gone, split between National and Fairstone. Who's next? EQ Bank, the digital-only operation, the credit unions that still operate independently, the provincial trust companies. This is where the first domino falls. And once it falls, the cascade is unstoppable because the math is unforgiving. Here's the part nobody expects. This isn't just about Canada. This is a global pattern. In the United States, community banks have been disappearing at a rate of several hundred per year since 2008. In Europe, the number of credit institutions has dropped by nearly 30% in the last decade. The same consolidation forces are at work everywhere. Rising compliance costs, technology investments, capital requirements, and interest rate volatility that only the giants can absorb. But this part isn't a prediction, it's math. When you create a regulatory environment that favors scale, you get consolidation. When you run monetary policy that swings from 0 rates to 5% rates in 18 months, you kill the marginal players. When you designate certain institutions as too big to fail and implicitly guarantee their survival, you create a two-tier system where everyone else is expendable. This part is non-negotiable. The incentive structure of modern banking regulation guarantees that we move toward oligopoly, not because regulators are evil or corrupt, but because the entire framework is built on the assumption that fewer, larger, more closely supervised banks are safer than many smaller, more diverse institutions. The simple logic of free market competition does not apply here. The data forces one conclusion. We are watching the construction of a financial cage, and most people don't even realize the bars are going up around them. Let me cut through the noise and show you exactly how this trap works, because understanding the mechanism is the only way to see what's coming next. Here's what the consolidation architects won't tell you. Every bank that disappears removes a negotiating option from your life. When you have 6 major banks instead of 8, you have fewer choices for mortgages, fewer options for business loans, fewer institutions competing for your deposits. And when banks stop competing, they stop innovating. They stop offering competitive rates. They stop caring about customer service, because where else are you going to go? This is not a conspiracy, it is a stated policy. The Bank for International Settlements, the central bank of central banks, has been explicit about this for years. Their framework prioritizes systemic stability over competition. And in their world, systemic stability means fewer, larger, more controllable institutions. It means a financial system that looks more like a public utility than a competitive marketplace. But here's where everything changes in a way that should terrify you. When Laurentian announced its dissolution, S&P Global immediately placed the remaining entity on credit watch negative. Think about that for a moment. Even after selling off the retail business to National Bank, theoretically de-risking the institution, the rating agencies said the bank was now more vulnerable, not less. Why? Because when you strip a bank of its deposit base, you strip it of its cheapest source of funding. What's left is a hollowed out institution running on expensive wholesale funding, trying to manage a commercial loan portfolio in an environment where credit conditions are tightening by the week. And this is the crack that becomes an earthquake. Fairstone, the company that bought Laurentian's commercial arm, is not a traditional bank. Let me be precise about what Fairstone actually is. It's an alternative lender owned by a private equity firm. Their business model is built on lending to borrowers who can't access conventional bank credit, higher risk, higher rates, higher defaults. They're good at what they do, but what they do is fundamentally different from what Laurentian Bank was built to do. The Laurentian name will technically survive under Fairstone's ownership, but it will be a shadow, a zombie brand operating in a completely different market segment. The blue chip working class institution that your grandparents banked with is dead. What remains is a subprime commercial lender using a legacy name for credibility. This is a default in all but name, not a default on debt, a default on the institution's fundamental purpose. Laurentian existed to serve the middle class, small businesses, ordinary Quebecois families who needed banking services from people who understood their communities. That mission is over. What you're left with is an acquisition vehicle for National Bank and a loan servicing operation for Fairstone. We haven't even reached the breaking point yet, because here's the detail even analysts tend to miss. National Bank didn't just buy Laurentian's retail business in 2025. Earlier that same year, they absorbed Canadian Western Bank. Think about the geography of this. CWB was the independent bank of the Canadian West, Alberta, Saskatchewan, British Columbia. Laurentian was the independent bank of Quebec and Eastern Canada. In 1 year, National Bank has eliminated regional competition in both halves of the country. This is not organic growth, this is strategic encirclement. And the speed at which it's happening suggests that someone, somewhere, decided that 2025 was the year to complete the consolidation of Canadian banking. Let me show you what actually happened with the employees, because this is where the human cost becomes undeniable. When National Bank announced the acquisition, they were very careful with their language. They didn't say, we're laying off Laurentian employees. They said, employees will not be automatically transferred, and we encourage them to apply for open positions within National Bank. This is corporate speak for mass unemployment dressed up as opportunity. Here's the reality. Laurentian employed thousands of people across Quebec, branch staff, loan officers, back office operations, risk management teams. National Bank doesn't need any of them. National already has branches, already has staff, already has operational infrastructure. The Laurentian employees represent redundancy, not value. So the vast majority will lose their jobs, and the ones who do get rehired will be doing so at entry-level wages, losing years of seniority and institutional knowledge. For pensions, this is catastrophic. Many of these employees had defined benefit pension plans tied to Laurentian's continued existence as a going concern. Those plans now have to be restructured, transferred, or frozen. The employees who are 10 years from retirement just watched their financial security evaporate because the bank they dedicated their careers to decided it was easier to sell than to fight. This is the moment the clock actually starts, because once employees start feeling the pain of consolidation, the political pressure begins to build. But by then, it's too late. The deal is done. The regulators have approved it. The branches are closing. The only thing left is the cleanup. And here's where the cascade becomes unstoppable for the customers. If you were a small business owner with a line of credit at Laurentian, your file is now sitting in National Bank's system waiting to be reviewed. And National Bank has different lending criteria, different risk models, different appetite for different sectors. There's a very real possibility that the credit line you've relied on for working capital, the one that Laurentian approved based on your relationship and your track record, gets cut or canceled when National Bank runs their assessment. This happens quietly. You don't get a press release. You get a letter saying, upon review of your account, we've decided to reduce your available credit from $200,000 to $75,000, effective in 30 days. And if you're in the middle of your busy season, if you've got payroll to meet and inventory to purchase, that letter is a death sentence. Multiply that by thousands of businesses across Quebec, and you start to see the ripple effects. Companies that were viable under Laurentian's lending standards become distressed under National Bank standards. Some will survive by finding alternative lenders at much higher interest rates. Others will simply close. Jobs will be lost. Suppliers will go unpaid. And the economic fabric of communities that relied on Laurentian's local knowledge and flexible approach will fray. This is where common sense actually becomes your enemy, because your instinct is to think, well, if they're creditworthy, they'll be fine. But creditworthiness is not objective. It's a judgment call based on models and assumptions and risk appetite. And when a giant bank takes over a smaller bank's portfolio, they apply their own models, models built for scale, not relationships. Let's cut through the noise and talk about what this means for your deposits. Right now, if you had money in Laurentian Bank, that money is being transferred to National Bank. The Canadian Deposit Insurance Corporation guarantees up to $100,000 per account, so your cash is technically safe. But here's what you've lost. You've lost the ability to choose a different institution. You've lost whatever interest rate advantage Laurentian might have been offering to attract deposits. You've lost the relationship with staff who knew your name and your financial situation. And you've lost something more abstract but equally important. You've lost the leverage that comes from having alternatives. When you could credibly threaten to move your mortgage or your business account to Laurentian, the Big Six had to compete for your business. Now, with one fewer competitor, that leverage is diminished. The incentive for any individual bank to offer you a better rate is reduced, because where else are you going to go? This is the mechanism hiding in plain sight. Every bank that disappears makes the remaining banks slightly more powerful, slightly more able to dictate terms, slightly less afraid of losing your business. And the cumulative effect over time is a financial system that serves the banks first and the customers second. But once this shifts, everything above it starts to shake, because Laurentian is not the last domino. It's just the most recent. Here's the part they're not telling you in the official announcements. The same forces that killed Laurentian are bearing down on every mid-sized financial institution in this country right now. High interest rates have crushed their margins. Technology requirements are bleeding them dry. Regulatory compliance costs are rising exponentially. And the Big Six are circling like sharks, waiting for the next one to weaken. EQ Bank, the digital-only institution, is profitable today. But how long can they maintain that in an environment where the giants are finally investing in their own digital platforms? Credit unions across the country are independent today, but they're also balkanized by province, unable to achieve national scale, vulnerable to the same margin compression that killed Laurentian. The regional trust companies, the specialty lenders, the niche players, every single one of them is running the same math, looking at the same deteriorating economics, and asking the same question: how long can we hold out? The data is unambiguous. Since 2008, the number of independent banks in Canada has been in structural decline. We've gone from a diverse ecosystem with dozens of Schedule I banks to a system dominated by six giants and a shrinking fringe of survivors. And the pace of consolidation is accelerating, not slowing. This was inevitable the moment the Bank of Canada started raising rates in 2022. You cannot go from 0.25% to 5% in 18 months without breaking things. The question was never whether banks would fail, it was which ones would fail first. Laurentian was the answer to that question, but it won't be the last answer. And this is where the countdown quietly began for everyone who isn't paying attention. Because the next phase of this consolidation won't be gentle acquisitions with press releases and regulatory approvals. The next phase will be emergency interventions, forced mergers, weekend deals announced on Sunday nights before markets open on Monday. The next phase will look like 2008, but instead of investment banks, it will be retail banks. Instead of Bear Stearns and Lehman Brothers, it will be regional institutions you've never heard of until they're gone. Here's what nobody expects: the credit unions might be next. Credit unions in Canada operate under provincial regulation, not federal. This has historically been their advantage. They're closer to their communities, more responsive to local needs, less burdened by national compliance requirements. But in an environment where scale is survival, provincial boundaries become prison walls. A credit union in British Columbia cannot easily merge with one in Ontario. They can't build national digital platforms. They can't compete with the big six's technology budgets or their deposit bases. And when the next crisis hits, when commercial real estate starts defaulting in earnest, when residential mortgages start going underwater in overheated markets, when the recession that everyone can see coming finally arrives, those credit unions will be exposed. They'll have concentrated regional risk, limited capital buffers, and nowhere to turn for emergency funding except the provincial stabilization funds, which are tiny compared to the potential losses. This part isn't a prediction, it's math. The structure of the credit union system was built for a different era, when banking was local and technology was expensive. In today's environment, where banking is digital and scale is everything, that structure is a vulnerability. Let me be precise about the timeline we're looking at. Because understanding when this accelerates is the difference between preparation and panic. We are in the eye of the storm right now. Interest rates have been high for long enough to inflict damage, but not long enough for all the casualties to be visible. Laurentian is the first major institutional failure of this cycle, but the contagion has already begun beneath the surface. Commercial real estate portfolios are underwater. Residential mortgages in Toronto and Vancouver are sitting on massive unrealized losses. Small business loans extended during the pandemic at low rates are coming up for renewal at rates that make them unserviceable. This is vanishing in real time, and most people are still operating as if 2019 is coming back. Here's where the convergence happens, and this is critical. We are facing three distinct forces hitting the Canadian banking system simultaneously, and each one amplifies the others. Force one, the interest rate shock. The Bank of Canada raised rates faster than at any point in modern history. This wasn't a gentle tightening. This was a deliberate attempt to break inflation by breaking demand. And it worked, but the collateral damage is massive. Every bank that built its business model around cheap funding and low-rate lending is now bleeding. Laurentian was simply the first to bleed out completely. Force 2. The technology trap. Modern banking requires massive investment in digital infrastructure, cybersecurity, fraud prevention, and customer facing apps that can compete with the big six. These investments cost hundreds of millions of dollars, and they have to be refreshed constantly. A bank like Laurentian, with limited scale and declining margins, simply couldn't keep up. They were fighting a technology arms race with a fraction of the budget their competitors had. The result was inevitable. Force 3. The regulatory squeeze. Since 2008, banking regulation has become exponentially more complex and expensive to comply with. Capital requirements, stress testing, liquidity buffers, anti-money laundering systems, consumer protection frameworks, every single one of these is necessary and important, but they all require staff, systems, and scale. A bank serving 500,000 customers faces almost the same regulatory burden as a bank serving 5 million, but with a fraction of the revenue to pay for it. The regulatory framework is crushing mid-sized institutions by design. And here is where the cascade becomes unstoppable, because these three forces don't operate independently, they compound each other. High rates crush margins, which reduces the capital available for technology investment, which makes the bank less competitive, which causes deposit flight, which forces the bank to rely on more expensive funding, which crushes margins further. It's a death spiral, and once it starts, there's no way out except acquisition or failure. But this isn't even the part that scares me. What scares me is that the regulators knew this would happen. The Office of the Superintendent of Financial Institutions, OSFI, the body responsible for banking supervision in Canada, has been warning about consolidation risk for years. They've published papers about the dangers of an oligopolistic banking system. They understand that when you have only 6 major banks, you create concentration risk, you reduce innovation, you harm consumers. And yet, they approved the National Bank acquisition of Laurentian with barely a whisper of concern. Why? Because in the moment of crisis, stability trumps competition every single time. OSFI's mandate is to prevent bank failures, not to preserve competitive markets. So when a bank starts to fail, their instinct is to facilitate an orderly acquisition by a stronger institution, not to prop up the failing bank and maintain competition. This is where the contradiction lives. Regulators want competition in theory, but consolidation in practice. And that contradiction is how we end up with a banking system that looks more like a cartel every year. Let's cut through the noise and talk about what this means for you personally, because the abstract policy discussion matters less than the concrete impact on your life. If you bank with one of the big six, Royal, TD, Scotia, BMO, CIBC, National, you're in the club. You have access to the institutions that are deemed too big to fail, too important to the system to let collapse. Your deposits are safe. Your services will continue. Your digital banking will keep improving because these banks have the resources to invest. But you've also lost something. You've lost the ability to escape. Where are you going to go if you don't like their fees, their service, their rates? EQ Bank, they're digital only with limited products. A credit union, they're provincial and can't match the big six's technology. An alternative lender like Fairstone, you'll pay double the interest rate. The illusion of choice has been replaced with the reality of dependency, and this part has already begun. For small business owners, the situation is more acute. Your relationship with your bank used to be a negotiation between equals. You provided the business, they provided the capital, and both sides had alternatives if the relationship broke down. Now the balance of power has shifted entirely. The banks have fewer competitors, which means they can be more selective about who they lend to, what rates they charge, what conditions they impose. If your business doesn't fit their algorithm, if your industry is out of favor, if your revenue is too small to matter, you're not a customer, you're a nuisance. And in a consolidated system, being a nuisance means being shut out completely. This is where the psychological trap closes, because human beings are hardwired to believe tomorrow will look like yesterday. We assume that the banking system that has existed our entire lives will continue to exist in essentially the same form. We assume that if one bank treats us poorly, we can simply move to another. We assume that competition will constrain bad behavior and ensure reasonable pricing. These assumptions are no longer valid, and the longer you operate as if they are, the more vulnerable you become. Let me show you what actually happened to customers who thought they had alternatives. In the weeks after the Laurentian announcement, there were scattered reports, nothing mainstream, just local news and social media, of customers trying to move their accounts to other institutions. Some succeeded. Others found that the bank they wanted to move to wasn't accepting new customers in their category, or required minimum balances they couldn't meet, or offered rates that weren't actually competitive once fees were included. The theoretical competition that exists on paper doesn't always materialize when you actually need it. And in a system with 6 dominant players, that theoretical competition becomes increasingly theoretical every year. Here's the part nobody expects, and this is where we need to talk about what comes next in the broader economy. Laurentian's collapse is not happening in isolation. It's happening in an environment where Canadian household debt is at record highs, where mortgage renewals are hitting families with payment increases of 40% or 50%, where variable rate mortgages are forcing people to choose between eating and keeping their homes. It's happening while commercial real estate values are collapsing, while office towers in Toronto and Calgary sit empty, while retail chains are closing stores by the dozen. The financial stress in the real economy is feeding back into the banking system, and the banking system is responding by tightening credit, which creates more stress in the real economy, which forces more tightening. This is the doom loop, and we're in the early innings. When Laurentian failed, it wasn't because of some exotic derivatives trading or reckless speculation. It failed because ordinary people and ordinary businesses couldn't service their debts in a high-rate environment, which meant loans went bad, which meant losses mounted, which meant capital eroded, which meant the bank became unsalvageable. And if that can happen to a 175-year-old institution, what do you think is happening to businesses and households that are far more fragile? This is observable, not theoretical. Insolvency filings in Canada have been rising steadily since rates started climbing. Consumer proposals, business bankruptcies, creditor arrangements, all trending upward. The official unemployment rate is still low, but underemployment is rising, precarious work is expanding, and the number of people working multiple jobs just to make ends meet is at historic highs. The foundation is crumbling, and most people don't feel it yet because they're standing on the parts that haven't collapsed. But once this shifts, everything above it starts to shake. Now, let me be very clear about what I'm not saying. I'm not saying the Canadian banking system is about to collapse entirely. The Big Six are genuinely strong institutions with massive capital buffers, government backing, and diversified revenue streams. They will survive this crisis, and they will emerge stronger and more dominant than before. What I am saying is that the system is changing in fundamental ways, and the people who don't adapt to that change will pay a very heavy price. So what do? Because this is where the conversation has to shift from analysis to action. First, understand that you are now operating in a consolidated oligopoly, not a competitive market. This means you have less leverage, fewer options, and more dependency on institutions that may not have your best interests at heart. Accept this reality because denial is the most expensive strategy. Second, diversify your banking relationships while you still can. If you're with one of the big six, consider keeping some funds in a credit union or digital bank as a backup. Not because those institutions are necessarily safer, they're probably less safe, but because having a secondary relationship gives you options if your primary bank suddenly changes its terms or closes your account. Third, and this is critical, stop thinking of your bank account as an asset. Your bank account is a liability. It's a loan you've made to the bank, and they can reprice that loan or change the terms whenever they want. Real assets are things you control directly: property, precious metals, equity in businesses you understand, skills that generate income regardless of which bank you use. The binary choice you face is this: do you want to own assets or do you want to own claims on assets? A bank deposit is a claim. A stock portfolio is a claim. A bond is a claim. These are all promises that someone else will pay you in the future, and those promises are only as good as the institution making them and the system enforcing them. Gold and silver are not claims, they are assets. You hold them, you own them, you control them. Land is not a claim, it's physical property that exists regardless of what happens to the banking system. A skill that generates income is not a claim. It's human capital that travels with you regardless of institutional collapse. I am not telling you to abandon the banking system entirely. That's neither practical nor necessary. What I am telling you is to recognize that the system is consolidating, competition is dying, and your position as a customer is weaker than it has ever been. In that environment, the only rational response is to reduce your dependency. The phrase they use in the industry is too big to fail. What that really means is too big to be allowed to fail by the government. And when something is too big to be allowed to fail, it becomes too big to compete, too big to care about individual customers, and too big to fear consequences for bad behavior. You are now banking with institutions that know they will be bailed out if they fail, which means they can take risks you would never tolerate in your own life. And when those risks blow up, not if, but when, the cost will be socialized, spread across taxpayers and depositors and anyone who can't opt out. History favors the prepared, and the window for preparation is closing. The Laurentian collapse is not the end of this story. It's the beginning. The forces that killed Laurentian are still active, still gathering strength, still hunting for the next vulnerable institution. And with each collapse, the survivors become stronger and more entrenched. The system becomes more concentrated, and your options become more limited. This is not a temporary disruption. This is a structural shift in how finance operates in this country. And the people who understand that shift early will be the ones who protect their wealth and their options, while others are still trying to figure out what happened. So here is my final question for you, and I want you to sit with it. When the next bank announces it's being acquired or dissolved, when the next institution that you thought was safe turns out to be for sale, what will you do? Will you scramble to find alternatives that no longer exist? Will you accept whatever terms the remaining giants offer, or will you have already taken steps to reduce your dependency on a system that no longer serves you? The choice is yours, but the clock is running. Friends, thank you for being here today. The fact that you've stayed with me through this entire conversation tells me you understand that something fundamental is changing. Trust that instinct. The data supports it, the history confirms it, and the future will prove it. Prepare accordingly.